Greetings, folks. Welcome to the Liberty Call for Thursday, September 29th, 2022. I hope everybody's having a good day out there. It's kind of gloomy here in Colorado, and, folks in Florida have probably been dealing with a lot of rain. So let's send some prayers to them. Hope everybody's getting through okay. Haven't heard from my family over there, so I assume they're doing pretty good in the Jacksonville area. So looks like the storm pretty much weakened up by the time it got that far north. So I do have some friends on the West Coast and did spend a few years. My wife was working in the Tampa or the St. Pete area for about 2-year period. So I was doing a lot of back and forth because she was working for a company over there. So it's a shame. Looks like they got just a lot of high water and down trees, things like that. So mobile homes took a bit of a, kick in the nuts. But, all in all, just from the footage I've seen on here on Fox Business, looks like it's not as terrible as it could have been. But again, haven't been through a bunch of these myself. It's never really pleasant. So, all right. Well, let's go ahead. And if it's your first time watching, please give me a big old thumbs up, like, share, subscribe, all that good stuff. I would greatly appreciate it. Let's go ahead and look at the markets for today. They were not excellent, unfortunately. Looks like we gave back just about everything that we made yesterday. The Dow Jones was down 1.54% or 458 points, closed at 29,225. The S&P 500 was down 2.09%, closed at 3641. NASDAQ down 2.84%, closed at 10,737. Small caps were down 2.85. The VIX was up 5.5% or 5.5%, closed at 3185. Canada was down 1.1%, Brazil down 0.57%, Mexico down 0.85%. Let's see here. Let me hit the refresh button. Some of these are still coming in. Germany over in Europe was down 1.71%, UK down 1.77%, France down 1.53%, the Euro Stoxx was down 1.69%, Netherlands down 1.18%, Spain down 1.91%, and Italy down 2.4%. Switzerland down 0.92%, and Portugal was down 1.72%. So lots of 1% down in the European area. As far as in the Russian markets, the MOEX was down 0.51%, the RTSI was down 0.21%. Headed over to the Asian markets, see a little bit of green here. Japan was up 0.95%, Australia up 1.44%, New Zealand up 0.69%. Moving over to China, let's see, mostly red. The Shanghai was down 0.13%. The SESE component up 0.18%. China A50 was flat, down 0.06%. The DJ Shanghai down 0.1%. The Hang Seng down 0.49%. And the Taiwan weighted was up 0.51%. So, like I said, the Asian markets were where we see some greens, but the rest of the world was in the red. So, unfortunate, but again, news out yesterday that the Bank of England had decided to basically pivot from their tightening and from the strategy of trying to get rates inflation back under control. So now they're going to issue more bonds, and I don't know if they're going to freeze the interest rate where it's at. But, that's my fear here domestically here with the Fed, is that at the first sign of any real trouble, which we're kind of getting there at this point, people are going to start panicking when the market drops into, severely down territory. We got to get the inflation under control. So, I understand, they got a lot of different pressures on them. You got the president and his administration. You got big business, chewing down, and the banking cartels. Breathing down their necks. But in the end, if we just go back to the same doing the same things that led us to the problems we're having right now, that's just going to, leave us in a worse position later on. And we're going to have to dig ourselves out or climb out of a much bigger hole than where we're at today. And like I've said before, we could have avoided all of these things if we hadn't printed $5 trillion or increased the money supply by 40% 2 years ago. We would have gone through a downturn. We were due for recession. The yield curve had inverted in the fall of 19. I had fully expected that in sometime in the first half of 2020 that we would have gone through, a bear market, potentially a recession, but we were due for that cycle. It was well overdue from the last time we'd gone through it. And, the Fed came running to the rescue with all this COVID money. And, that's where we're at today, So, it didn't help me. I didn't get hardly anything out of it. And, today, asset prices are down. It hurts my business in the long run as far as the revenues I make. So, yeah, I would have rather gone through it then and, climbed out of a knee-deep hole as opposed to a 10-foot hole at this point. So, all right. Well, let's go ahead and read through today's market recap. S&P 500 tumbles deeper into bear market as Apple leads tech rout. The S&P 500 fell Thursday as the respite from a day earlier proved short-lived after an Apple rout on concerns about the strength of the consumer triggered a sell-off. Apple fell more than 5% after Bank of America downgraded the company from neutral to buy, citing worries about a slowdown in consumer spending. Really, people are going to eat rather than buying cell phones, in my opinion. The tech giant is expected to face, quote, material negative estimate revisions, end quote, over the next year, Bank of America said, pointing to a slowdown in services and relatively lackluster iPhone lead times as signs that consumer demand will slow. The downgrade soured sentiment on semiconductor stocks with Apple chip suppliers, including Taiwan Semiconductor Manufacturing, Qualcomm Incorporated, and Analog Devices, Inc., adding to recent losses. NVIDIA's 5% slump, meanwhile, also weighed on chip stocks. Rising yields, the enemy of growth sectors like tech stocks, also added pressure on the broader market as an upside revision to the second quarter inflation suggested that the Federal Reserve will have to persist with rate hikes. The personal consumption expenditure price index, the Fed's preferred inflation gauge, was revised higher to 7.3%, while the core PCE price measure, which excludes food and energy, is closely watched, was upwardly revised to 4.7 from 4.4. The latest weekly jobs data claims, meanwhile, also suggested the Fed has more work to do as claims in the week ending September 24th unexpectedly fell 16,000 to 193,000. The Cleveland Fed President Loretta Meester said inflation was unacceptably high, and reiterated the Fed's willingness to bring inflation back down to the 2% target, even if the economy slows. Consumer stocks, meanwhile, fell more than 3% after more than a 23% plunge in CarMax after the auto dealer reported quarterly earnings that fell short of analyst estimates. Bed Bath & Beyond fell 8% after reporting a wider than expected loss, paced by decline in Buy Baby, its baby merchandise chain. In other news, Peloton Interactive fell 16% after detailing plans to sell its equipment at Dick's Sporting Goods, a move that points to further signs of slowing demand for fitness equipment. All right, so next up, a little more on the jobs news. The number of Americans filing new claims for unemployment benefits fell to a 5-month low last week as the labor market remains resilient despite headwinds from the Federal Reserve, stiff interest rate increases, and slowing demand. The weekly unemployment claims report from the Labor Department on Thursday, most timely data on the economic health, also showed jobless roles shrinking to their lowest levels in just over 2 months in mid-September. That raises the risk that the unemployment rate will drop this month, keeping the Fed on its aggressive monetary policy tightening. Initial claims for state unemployment benefits decreased 16,000 to an adjusted 993,000 for the week ending September 24th, the lowest level since April. Data for the week prior was revised to show 4,000 fewer applications filed than previously reported. So some good news there. Economists polled by Reuters had forecast 215,000 applications for the latest week. Getting into the longer term claims, the claims report showed the number of people receiving benefits after an initial week of aid fell 29,000 to 1.347 million in the week ending September 17th, the lowest level since July. The so-called continuing claims data, a proxy for hiring, covered the week that the government surveyed households for September's unemployment rate. Continuing claims dropped 65,000 between August and September survey periods. The unemployment rate rose to 3.7 in August from 3.5 in July. So I think that's all the data I wanted to go through there. So again, some good news. The jobs numbers are continuing to fall. So that is some positive stuff. All right. Last article I'm going to cover. Mortgage rates raced towards 7%, hit a 15-year high. Mortgage rates surged closer to 7% this week in a move that caused even repeat buyers to back off from purchase plans. The average rate on a 30-year fixed mortgage jumped to 6.7% from 6.29 last week, according to Freddie Mac, its highest level since July of 2007. Rates increased over a full point this month and are now more than double they were at the start of the year. Quote, there is a significant change in homebuyer sentiment, especially with rates, with what rates have done in recent weeks. End quote, Jason Sharon, owner and broker of Home Loans Inc., told Yahoo Money. Quote, I've had 10 people in the last 10 days effectively decide that because of the change in rates, they're withdrawing from the home shopping for a bit. Most of them were repeat buyers. With mortgage rates now almost 3.5% percentage points higher than they were at the start of the year, more and more buyers are pulled back. Demands for mortgages stands at a 22-year low, according to the latest data from the Mortgage Bankers Association. As high rates continue to depress purchases and refinance activity, applications fell 1% from a year earlier and were 29% lower than the same week a year ago. Existing home sales have declined for the seven straight months, according to the National Association of Realtors. Pending home sales, a leading indicator for the housing markets, fell 2% in August from a month earlier. Contract signings are down 24.2% from a year ago. And so here, for instance, a median home price of $435,000 translates into a monthly mortgage payment of $2,300, according to Realtor.com. That's 44% of the median annual income of $71,000 before factoring in property taxes, insurance, and other expenses. And that's simply too high for many buyers out there. There's also there's another demographic that this climate has given them the opportunity to own an entry-level home with less competition. Perez Chica said, buyers that took action had an advantage. We were able to get seller concessions, and buyers felt they had the upper hand for the first time in a decade. So yeah, fortunately, in the current situation, the buyers are in control again. So anyways, all right. Well, that's everything I had for today. So if anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. And I'll be back tomorrow with the weekly wrap up. Everyone have a good evening. Bye-bye.